Check out the THOR Index update as well as a surprising chart showing that momentum is waning in the markets. Hi, Jim Gore from THOR Wealth Management. Well, it's that time again to do, as we always do at the beginning of the quarter, give an update on what our THOR indexes are telling us. And now you have to keep in mind that these are measurements that we use for managing our clients' portfolio. Here at THOR, what we're trying to do is get the highest rate of return possible for our clients with the least amount of risk, with, of course, permanent loss of capital is a major risk, but also volatility in the client's portfolios. We want to minimize that when things are expensive and the risk is high. So we look at the THORdex, and this has remained here for the last year or so pretty high. It's at 75. And so what this is telling us is that there's higher risk of being in the equity market, and this is U.S. large companies that we're talking about. This is not looking at emerging markets, international, small company, and so forth. This is U.S. large company. It's saying to us, you want to be underweight U.S. equities, especially U.S. large companies, and underweight equities as a whole. And that what we mean is not going from 100% in equities down to zero. We want to be underweight, which means that if you're 100% equities, we're right now at about 75, 80% in equities in our clients' portfolios, using alternatives as a way to look at risk minimization. So the other thing we look at is on the bond side. On the bond side, we look at two things. We look at credit and we look at duration. Credit basically is, do I want to own treasuries where there's deemed no credit risk? Or do I want to own a high yield bond that there's a risk that I might not get paid? Right now, it is a -2, a little bit over -2. It was worse before this, a few months back, but it is still negative. So you don't want to take a tremendous amount of credit risk. If anything, you want to do it on the shorter side. The other thing is duration. Duration is, do I want to own a 1-year bond or do I want to own a 10-year bond? And this has had some major moves over the last 5 years. Back in 2022, when U.S. Treasuries were yielding 2%, it was very negative, almost a -3. It went up to a positive 2.5, almost 3, when 10-year Treasuries were yielding over 5%. And duration is something that we're really pushing our clients' portfolio. Right now, it is a little bit under 2, which means that you do want some duration in your portfolio. In other words, you're getting paid to own longer-term bonds where you were not being paid back 4 years ago when duration was a -3. Another way of looking at things is in our portfolios, as I mentioned, we want to get the highest amount of return with the least amount of risk, and that's volatility. So if you're getting in a bond 5.5%, and the expectation on the THORdex is that equities are going to give you 6.5%, is it worth, over a 10-year time period, having 3 times the more volatility in equities for that little bit of return? In other words, we want to get a premium over what bonds are offering that is higher than 0.5% to 1%. So that is what this indicator is showing us here, is that stocks on a risk-adjusted basis are not as attractive as bonds. And so bonds are something that we like in the portfolio compared to stocks, which makes sense because on the equity market right now in the S&P 500, the yield is only 1%, maybe 1.01%. It is the lowest that I can ever recall in my history of investing. Now, there is one thing that I think is very interesting that I have never seen in my 40-year career. And this is looking at something that's technical. I'm going to show you what we're seeing on a weekly basis on this chart. And this chart here is we're looking at the NYSE, and I can show this for a lot of U.S. indicators where it's the S&P 500, NASDAQ, and so forth. What we're seeing here is if you look at the price versus the CMF, which is a money flow index, which is a momentum, and you'll notice back, there was a time period that CMF went negative. Notice that the NYSE went negative. Right now, I'm seeing something that I've never seen. you're seeing the stock market is going up while money flow is going down. That means money's not going into the market. This is a very negative indicator. There's two things that are going to happen. Either you're going to see money flow go up and stock prices remain steady, or you're going to see stocks go down in order to reflect what's happening in CMF. And I've got history on my side. So this is a chart looking at the weekly numbers going back for 50 years. And if you notice all the little arrows that I have there, you've seen the market go down when CMF was negative, when the money flow was negative. That is something that is totally different than what we're seeing right now. It's a huge negative divergent indicator that we are seeing throughout all the U.S. equity markets at this juncture. And as I said, the THORdex, where it is with this, that's why you want to be underweight U.S. equities, because there's a risk right now, especially compared to bonds, that the market might remain flat for a time period, or it could come down as it has over the last 50 years. If you have any questions or have any concerns with your portfolio or need help, please reach out to us at THORwealthmanagement.com or give us a call. Take care and talk to you in a couple weeks.
Subscribe to the THOR channel today.